This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call, live from the CNBC-TV18 Motilal Oswal studios. It's a Friday morning, I should say. Thank God it's Friday. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Good morning. Why are you feeling like that? It's been a long week, has it not?
Every week is a long week, right? And, only 3 weeks done in 2023 so far. But, I mean, it's going to be a long day as well before we can say thank you, goodbye.
But there's good news. Next week, I think we have one day off, right?
Oh, 26 Jan.
It's a truncated week, guys.
Nice.
Be a little shorter. But results will be pouring in thick and fast, so
absolutely.
That nullifies some part
Good news, Nigel. Thank you for that. All right. Do we have good news for markets per se? I'm not very sure because U.S. Markets were down once again. By the way, the market is, if you just look back at the daily changes for the last many sessions, actually all through this year, we're still battling the ranges, right? The lower end is still holding. The upper end has not been taken out. Despite the promise of the market rally that we saw earlier this week. 2 days we had those triple-digit gains and then it's kind of fizzled out. Can we kind of sort of start to come back up against? If you go with US market action, it's not looking very encouraging. So the S&P 500, for example, lost again. I mean, 0.75% lower. The Nasdaq was down a little bit more. If you look at the dollar market, it's still weak, which is good news for emerging markets. Oil is not kind of jumping up to... It's still high as compared to where it was on the 31st of December last year. So it's moved up, but it's not galloping higher. Rates are very comfortable. The US 10-year is at about 3.4. And it's getting a bit of a muddle now, right? I mean, you look at the data which is coming through, you look at the commentary which is coming through. Good news was bad news is good news. It's going to be a muddled kind of a picture because, and that's the way it always is, right? So you had the jobless claims number yesterday, which indicated that the labor market in the US is still very tight. That is good news because if you're worried about recession, this shows that, I mean, the labor market is still strong. There's demand for workers, right? But that kind of raises question marks about the Fed's terminal rate. How much more does the Fed have to do? But you had top Fed officials yesterday saying, and actually in all but confirming that in February, it will not be a 50 basis point hike, but a 25 basis point hike. So, the expectation that it's going to be 25, maybe 1, maybe 2, maybe 3, depends on who you ask. But it's going to be 25. It's not going to be bigger. So that aggressive, very sharp 50 basis point, 75, that is now a story of 2022. But as I said, I think because, data is incoming and I think on the 1st of Feb, we get the new jobs data, the labor market data, the big jobs number, and I think we'll get a better sense of how this is looking. The labor market, of course, is one of the top indicators for the Fed still. Earnings here, I'll come to Nifty and Bank Nifty levels, etc. But earnings here are also not giving a very comfortable picture. You look at Asian Paints, you look at numbers from Havells, they are definitely indicating some amount of consumer slowdown. We'll talk about these in a bit from now. Asian Paints did see a sharp reaction downwards. Technically, it is not looking very good. There are earnings cuts as well, by the way, for both FY24 and FY25. And Havells also, there's not a very strong set of numbers. It's actually in line, subpar. You also had HUL numbers which came through. There, the problem is the numbers are decent, right? 5% volume growth, but there is this royalty increase which the parent has imposed, and that may be negative sentiment-wise. But I don't think it should be a huge deal, and that's something we'll talk about again. But the point is, there is no clear momentum on the upside on the back of earnings as well. And these are big companies, big stocks we are talking about. So let's get to the Nifty levels, right? On the Nifty, it's got resistance at the two levels, 38.2 and 50% retracement levels. The 38% retracement is 18,191, which we almost got to day before yesterday and then sold off. And the 50% then above that is 18,324. Those are the two numbers respectively, the 38 and the 50%. You've got 17,583, which is the low a few days back, which is important. It should be held on the way down. Bank Nifty, for the second straight session, turned down from the 20-day moving average. The 20-day is at 42,554. I think the high yesterday was about 42,500, 5 something. So we almost got to that. Day before yesterday, we touched that and fell. And yesterday also, we almost got to it and then fell. So that's the level to take out for the Bank Nifty on the way up. We've been putting out levels on the downside over the last many sessions. So those kind of hold. So a bit of a muddle, I said, and still battling the ranges. That's the story of the market so far. Guys, hi.
Absolutely. I think that's the key word, right? The range. This Nifty is so range bound between 17,800 and 18,200. There is no reason for the range to break either way. And that's the sense you're getting in the market as well. Even this morning, the SGX Nifty is absolutely flat, an indication that perhaps we may open sideways. The good part is that FIIs, after, I think, 19 days, excluding the day when you had the Samvardhan block on 17th, after 19 days, FIIs are finally bought in the cash markets to the tune of around 400 crores. So that's important. And the Nifty has given all the global cues. The Nifty has held on to 18,100. Now, there are a lot of factors. The focus is going to shift on to earnings because you have Reliance that comes out later in the evening. Over there is a moderation that we're expecting this time in the consumer-facing businesses, both Jio and retail. So that's important. Through the course of the weekend, you have ICICI Bank and Kotak Mahindra Bank tomorrow. There's Axis Bank on Monday. So the focus will now shift squarely onto some of these large earnings. If there is any major disappointment, then the market may tread further to its lower end of the trading range. Now, because of the weak handover from the US, the market today may see a lid on its gain. So the Dow is down quite a bit. In fact, this week, the Dow is down almost 4%. And it's the worst week since the month of September. So coming back, the resistance on the upside is 18,200 to 18,250. On the downside, the support is 17,800. And the market could perhaps continue to gravitate within that range. We just have 7 sessions left before the budget. Of course, the budget is just a financial statement, so it's generally not very market moving. Yes. But that's another big event to watch out for.
Well, Sonia, a couple of comments first on the institutional flows. This week itself, the FI as well, the net sell numbers come down to a paltry 100 crores. Or remember, last week they were averaging closer around 1,900 to 2,000 crores per day. So that's a positive. In trade yesterday, well, the FIs, the number looked quite good, but the DI participation was much lower. It was 20% lower than the average that we've seen. In fact, yesterday, the participation from the DIs was as much as what we saw on January 2nd. So just keep that in mind. In the F&O market, well, yesterday there was some unwinding of positions. So you did see that the open interest on the Nifty did come in lower. What did the FIs do? They added some mild shorts and they unwound some longs. So the long short positioning now is at around 50% apiece. The options data is quite interesting. It seems that pre-positioning ahead of the budget, in case there are some murmurs, in case there are some expectations, some punt buying on both sides, the call and the put side. But the more important data is what's happening on the writing side. So the 18,000 put that was active yesterday, the premium is around 60 rupees. And also the 18,200 call, the premium out there is around 60 rupees, and that as well was equally active. Which brings us to the levels then. On a closing basis, you want the Nifty to defend the 20 DMA. If the 20 DMA gets broken, then maybe in fact we go back to around that 100 DMA odd. But if we can end higher today, and defend those lower levels, then it gives us a chance to try to move to higher levels, which come in at around the 50 DMA. That's around 18,300, which I expect stiff resistance at those levels. So the support range, 18,000, 18,030, going by the options data, and resistance, 18,200, 18,250. The Nifty Bank, every time it's trying to attempt to go to around 42,600 odd, it's seeing some resistance. And that's where the 20 DMA is. So we'll need the Nifty Bank to cross that level to give it a fighting chance to go to fresh all-time highs. Will the IT index that's been outperforming till now, will it take a bit of a breather? A couple of those mid-cap names, whether it's Emphasis, they reported a degrowth on a quarter-on-quarter basis, one of the few IT companies to report that. Will that stop the IT stocks in its path? And L&T Tech as well, they've cut their revenue guidance to the lower end out there. So till now we had that the IT index was doing a relative outperformance. Will it pause for breath? That's going to be important because that's been holding one end up. SGX Nifty suggests a start in the green. I think we pull back a little bit at some point of time. And maybe in fact with that 18,030 level holds up, then risk reward could be favorable. Sonia.
Okay, well, there's lots happening on the show later today. So before we start, let me tell you what's lined up in the first half hour of the show. We'll get you updates from the markets across the globe. Mark Matthews of Bank Julius Baer and company will be joining us to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At around 8:30, we will do a fundamental stock analysis with Amisha Vora of Prabhudas Leeladhar. so do stay tuned in for that. But first up, let's get you some more cues from Dalal Street. On the equities front, we have Lawrence Belanco of CLSA, who says that the Nifty has spent the past 3 weeks holding in a narrow range after failing to sustain the original breakout above the late 2021 highs. He says this narrow range provides immediate support at 18,000 to 18,100 and resistance at 18,300 to 18,356. And this action leaves the Nifty consolidating between 17,300 to 17,302 support and 18,300 to 18,596 resistance. So basically in a very narrow trading range. He said it would take a break below the 17,300 to 302 support area, which includes the 200 DMA, to suggest that the original breakout above 18,300 was not a genuine breakout. He also says such a move would imply a deeper setback towards the next support at 16,764 and potential 15,200 area. Okay, that was so many numbers in one breath.
Why did you repeat that?
At one point I didn't understand what I was saying myself, but I think basically it's to be in a trading range.
We'll put that out again a little later. Well, let's get you some money market news as well. Bhaskar Panda of HDFC Bank says the US market is slowing down as successive data releases show, yet Fed speakers have been asserting on the need for higher rates. He says oil prices remain high as the dollar index hovers just above the 102 level. He adds in Indian forex market, supplies have increased, resulting in mild rupee appreciation against the dollar. He's expecting the dollar INR pair to trade in a range of between 81.15 to 81.4 for the day.
And on the bonds, Bhaskar Panda says that there is hardly any movement in Indian bond yields. He says similar conditions to stay in place today and expect the 10-year benchmark to trade in a range of 7.3 to 7.35%.
All right, we have a lot of stock-specific action to track for you, and we'll get to that in just a bit. As always, in our top 10 segment, we have Vedanta, Sun Pharma, India Mart, Coforge, PVR, all the stocks on the back of positive news flow. But on the flip side, you have Hindustan Zinc, HUL, Emphasis, L&T Tech, and AU Small Finance Bank. They are stocks that could react to negative news flow.
Okay, Mark Matthews of Bank Julius Baer is back with us to talk all things market. Mark, great to have you with us here. Thank you very much. You know, on the S&P, we are again back over the last 2 days quite aggressively. Not overnight was still mild, but the day before, on Wednesday, the U.S. market sold off aggressively. Are we starting a fresh leg down?
I don't think so. I don't see why. To my mind, we have a earnings forecast this year, which is easy to beat. The consensus is only looking for 2% earnings growth this year. We have inflation, which is clearly rolling over and on its way down. And the biggest reason the markets went down last year was because of the higher interest rates that were prompted by inflation. And yes, the economy will slow down as a function of those higher rates. But to my mind, if there's a recession, it will be only a technical one, and you'll barely feel it. I mean, the difference between minus 0.5 and plus 0.5 GDP growth is very small, and so I don't think the market should sell off a lot.
Okay, you don't think the market should sell off a lot. Mark, good morning. What about India? Despite all the weak global cues, the Indian markets are quite resilient. What have you made of the earnings season so far, and how are you approaching the markets, say, in the second quartile of the year?
I also think it's fine. By the way, I forgot to say that I do think that the interest now is clearly more in bonds than in stocks in the United States, and so that would be reflected internationally as well. And investment-grade bonds year-to-date are up about 4.5%. High-yield bonds are up about 3.5%. So bonds are doing better than stocks, and I think that's because people can see that inflation's coming down, and therefore interest rates will follow, the 10-year back at 3.4. And where that leaves India, I don't think it's a bad place, because the dollar is also softening as these interest rates come down. And I saw an interesting chart the other day of the leadership in the S&P throughout the decades. Usually one sector will lead the market for a few years in a row. Just like you'll remember, the last 10 years was all about technology. Well, in the 2000s, in the aftermath of the dot-com bubble collapse, there was no strong leadership in the S&P, and actually it wasn't a very good decade for the US market. It was a very good decade for emerging markets. And just like back in 2001 or 2002, I don't think anybody could have seen that about to happen. If you'd gone back 20 years, I don't think anybody would have believed that the 2000s were going to be such a great decade for emerging markets. So I think they have a lot of potential now. And of course, India is an emerging market. And I think it'll do just fine this year.
All right, Mark, we have the Fed meet that's coming up. What are you penciling in? Earlier we were working with around 50 basis points, but gradually as the weeks progressed, it appears now the expectation is 25 basis points. What's your sense?
25 basis points, and that's it. I don't even think they need to raise, but I think it's sort of a face-saving thing because they've been so committed to raising rates. It would look a bit odd if they didn't do it one last time. But after that, we don't see any more because we just don't see the reason. And if you extrapolate the sequential change in inflation over the last 2 months, which has been 0.1% month on month, we should get to about 2.5% year-on-year inflation in May. And that, I think, is a good level. So the commodity prices are soft and property prices in the United States are soft. There's absolutely no reason why inflation should not continue to fall. So, yeah, the last one, February 1st. And I think that's why the 10-year Treasury is at 3.4%, because the market can see that.
At some point, as you say, and you say it'll be Feb and one and done, basically, in terms of rate hike. And a very brief answer to what is a question which perhaps requires a very long explanation, but we don't have the time. But I want to ask this: do you think rates will go back to very low interest rates in 23 or 24 or 25, or you think we're going to now see a more orthodox monetary policy globally?
Yeah, more orthodox, thank goodness, because the last 10 years, unorthodox monetary policy created a lot of bubbles and things that shouldn't have happened. But the most important thing, may I say, is the fact the 2-year Treasury note has peaked. The yield on the 2-year Treasury note has peaked, and that always led the last rate hike by about 3 to 4 weeks. So that, I think, is the real canary in the coal mine, and it has indeed peaked and rolled over.
All right. And more orthodox monetary policy basically means real positive rates, right? If not...
Yes, and thank goodness, because you should have to borrow, pay when you borrow money, yeah.
All right. Thank you very much. Great speaking with you, Mark. Have a great weekend, and we'll see you back soon again. Thanks indeed. We'll take a very quick break here. What we'll do is we'll come back with our research team, our top stocks to watch out for lined up next. Stay with us.
It's Friday. It's the last day of the week, but we have plenty on our plate this morning because the global cues have been on the weaker side. The SGX Nifty is indicating a very flat start, and you have big earnings through the course of today and the weekend, starting with Reliance later this evening. So we'll talk about that. But first up, let's get straight to some numbers. Nigel, you're looking at Vedanta and Hindustan Zinc.
Well, Sonia, in the final hour of trade, yes, in the final 30 minutes, you pull up Vedanta as well as Hindustan Zinc. Both the stocks spiked up. And I was mentioning to Prashant and Rima that there's two possibilities that could happen. Either they give a big dividend or they go ahead and buy Vedanta's international assets. And both of them came about. It was shaping up as a thriller, and there's nothing short of that. Numbers bang in line. No questions asked out there. On the dividend front, they went ahead and declared dividend of close to around 13 rupees. So for this year so far, they've declared 49 rupees 50 paise, which is good from the government of India's perspective because they have close to around 30% stake, and from Vedanta's perspective because they get 65% of the stake out there. The big news, though, was that Vedanta will sell its zinc international business to Hindustan Zinc for around $3 billion, and the transaction will happen in a phased manner, with 80% getting paid out immediately. The deal is done at around 10 times EV per EBITDA, just annualizing what they did in the first half of the year. So it's at around 10 or even more, 11, 12 times EV per EBITDA, which is not cheap at all. The problem is it takes all Hindustan Zinc's cash away from its books. The net cash is around 11,000 crores odd. So it's negative for Hindustan Zinc. Related party transaction, expensive valuations, and takes out all the cash. The utilization of these proceeds by Vedanta will be important. Will they pay out a dividend to the shareholders? So now Vedanta comes into play because they're going to be getting a lot of money. Or will they do an ICDA, lend some money to the promoter entity? That's going to be a big question mark out there. And what happens post this? Will it get the green signal from the Government of India? Because Government of India has 30% stake in Hindustan Zinc. The very fact that they have a board representative, it appears that they pretty much could be on the board. And to make matters worse, Hindustan Zinc also introduced a 2% royalty to the promoter entity. So put it all together, Hindustan Zinc should be under pressure today, though there's only 2-3% float in the market. And Vedanta should be flying away, continuing its upward trajectory.
All right, Nigel, thanks very much. That's an interesting story, which we will continue to discuss, but that's the synopsis of it. Lever, HUL is going to be the next one we're going to talk about. Mangalam is standing by. There were numbers which were decent. There's a royalty, which is, I think, a bit of a prickly issue. Mangalam, morning.
But as far as the results for HUL are concerned, the third quarter, they were largely in line with expectations, albeit at a higher end of street's expectations. But the fly in the ointment was the announcement that they've made with regards to rearranging the royalty agreement with parent Unilever itself. So let's talk about what's good about these numbers. Revenues coming in at 15,228 crores, above street expectations of 14,860 odd crores. The volume growth came in at 5%, higher end of the range of 4 to 5 odd percent. And the EBITDA as well, a little over 3,500 crores, beat street expectations of 3,500 crores itself. Gross margins improved quarter on quarter, and the net profit as a result of which came a little over 2,500 crores. The street was working with a number just under 2,500 odd crore rupees. The management commentary as far as demand and operating environment is concerned was rather optimistic as well. They said that, inflation has, we've seen the worst of inflation, and now things are improving, and things in both rural and urban India as far as demand is concerned are improving as well. But the fly in the ointment, and what wasn't good about these results, was the royalty agreement that has been revised with Unilever. They will now pay 3.45% of sales versus 2.65% that they paid earlier. This will be increased in a staggered manner over the next 3 years by 45 basis points in this year, by 25 basis points in 2024 and 10 basis points in 2025. So this 80 basis points increase will take place over the next 3 years. The management said that this has been revised for a period of the next 5 years. So let's see where that goes, because maybe the street wasn't prepared for this and will not like this. The demand situation as well as the numbers, no problems. The royalty, a googly.
Okay, all right. Thanks a lot for that. Mangalam Ekta joins us to tell us about Sun Pharma. They did an acquisition overnight. Ekta?
Yes, thanks for that. Well, it is a US-listed company that Sun Pharma will be acquiring. It is betting big on its specialty business. So it is Concert Pharma that they will be acquiring. It's a biotechnology company for $567 million initially, and up to around $250 million in terms of milestone payments. So they will be shelling out $8 per share initially, and the stock Concert Pharma ended up around 20% an additional $3.50, which is based on certain milestones being bet in the future. Sales of Concert, it's a net loss for the first 9 months of this year at around $90.6 million. But remember, it is an R&D company and it is cash rich. Now, in terms of what Concert Pharma brings to the table, their lead molecule is basically to treat alopecia, and there is an expectation that they could possibly file an NDA, a new drug application, with the US FDA in the first half of this year. If it is successful, it's a huge upside for Sun Pharma. Peak sales, according to analysts, could be around maybe $250 to over $300 million in the next couple of years, but it's difficult to say at this point in time. Alopecia is an unmet need at this point in time. There is no real drug there to treat it, and hence it would be a positive. But in the near term, it could impact margins, and there could be an EPS dilution because of the losses that Concert Pharma has.
All right, thanks a lot for that. Well, let's go across to Rima now. Now, what stood out this earnings season in technology is that despite all the talk of slowdown and the stock prices falling, the numbers are actually not too bad. Coforge has upped its guidance as well. Rima, take us through the list that you're tracking today.
Well, for every good numbers, there are always a few bad ones. So let me start with the two negative numbers from the IT pack. One of them is Mphasis. Now, Mphasis revenues declined on a quarter-on-quarter basis, down 2.5%. This is the only IT company which has reported numbers so far which has clocked in a decline in their revenue. So it's a negative. The key reason is their exposure to the mortgage business, which is hit due to rising interest rate. But on the flip side, the deal wins are very strong. The deal wins have crossed $400 million, the second highest on record. But I'm going to go with red for emphasis. L&T Tech is also a miss this time. The revenue growth is just up 0.4% in dollar terms. In constant currency terms, it's flat. So it's flat revenues for L&T Tech, and that's the reason why the company has cut its full year guidance. Now FY23 revenue growth will be seen at 15%. Margins, though, have expanded to record high levels. So it's a miss on the top line, a beat on the margins. But on the whole, given the guidance cut and the muted commentary, I'm going to go with red over there. IndiaMart, on the other hand, has reported a steady quarter. Revenue growth 33%, margins down year on year, but flat on a quarter-on-quarter basis. The bottom line has been boosted by a one-time gain of about 66 crore from the sale of ProcMart. Collections have been strong. The only miss in the numbers is the paid subscriber addition. That's a key metric that we track, and that is tracking slightly slower. Coforge, on the other hand, has reported a good quarter. No beat on the top line. The revenue growth was about 3.7%, but the order wins are at the highest ever level, $345 million, and the FY23 guidance has been upgraded to 22%. Margin guidance has been maintained. So red for emphasis in L&T Tech, where the top line has been very muted. IndiaMart steady. Coforge looks pretty good. Back to you.
All right, Rima, thanks very much for that. Now, AU Small Finance Bank is the next one. The reported numbers. Abhishek is here with details and what to watch. Abhishek, morning.
Morning, Prashant. So it's a mixed bag coming in from AU Finance, and in a rising interest rate scenario, they are not able to command on yield better than the cost of funds. Now, that's a worry factor. So the net interest margin is flat sequentially. Quarter on quarter, it's just 6.2%, despite the fact that AUM growth was at 7.4% quarter on quarter. The cost pressure is seen given the fact that CASA ratio has declined on a sequential basis, as well as the fact that, incremental deposits or liabilities are coming in at a higher cost. They have used contingent provisions or the pool of provisions that they had created earlier, which has actually helped them, have a higher PAT than analyst estimates. So gross NPA ratio largely stable. It has come in at 1.81% when compared to 1.9% in the previous quarter. The restructured book has declined marginally by 5 basis points sequentially, and P&L versus antique estimate, NII is up 8 crore or 8 crore higher than antique estimate, coming at 1,152 crores, and PAT on account of the contingent provisions that they have used has come in at 393 crore when compared to 361 crore that antique was estimating. Back to you.
Okay, thanks a lot for that. Well, let's move on. One of the stocks in focus today could be PVR. Now, the numbers on a year-on-year basis look very good. Of course, not comparable, because same time last year was a complete washout for them. But Sonal is here to take us through the fine print. Sonal, how did it look?
Good morning, Sonia. Well, it looked much better than estimates, and that's the reason why I'm going with green on PVR today. As you said, yes, on a YOY basis, it's not comparable, but the fact that they've beaten estimates as far as analyst expectations is concerned is positive. Margins, they have increased by 370 basis points to come in at 30.6%. The average expectation was around 30%. Net profit also in line with expectations this time around. If we talk about occupancies, looking at the internals, they actually decreased on a YOY basis to come in at 29%, but their average ticket price, that increased 16% on a YOY basis. So the top line growth was also driven by the price increases that the company took. And in both the businesses, movie exhibition and movie production and the other segments, the company has seen a growth. The net debt for the company has declined as well on a quarter-on-quarter basis, has come in at 927 crore rupees. So that's a positive. CLSA says that they have a buy rating with a target price of 2,430 rupees. PVR collections for top movies was up 75% on a sequential basis. So that's a positive. Strong content lineup in 2023, and screen expansions is the next big trigger. Of course, the PVR Inox merger is also something that they're watching out for. UBS says that merger process is likely to complete in next 6 to 8 weeks, and the combined entity, it will trade at 13 times FY25 earnings. So there is some potential for re-rating. So apart from earnings, also watching out for the merger.
Okay, thank you so much for that. Thanks to our entire team. In fact, plenty of stocks to watch. In case you missed out on them, we'll of course run through them over the next 1 hour as well. But stocks with positive news flow, there's Vedanta, Sun Pharma, IndiaMart, Intermesh, Coforge and PVR. While stocks with negative news flow, there's Hindustan Zinc, HUL, Emphasis, L&T Tech and AU Small Finance Bank. Well, you just saw some flashes on your screen, very important, coming through. Sources saying that the SEBI has gone ahead and conducted search and seizure operations in this front-running case and has searched the residence and office locations of 6 entities. Now, the regulator's search operations are related to alleged front-running in shares recommendations that are put through on TV channels. And just to make it, just to put it on board, that CNBC-TV18 and the group channels are not among those associated with the SEBI probe. This is, of course, a great initiative on part of SEBI in order to sort of put front-running to an end in whatever way possible and to prevent innocent shareholders and investors from getting caught in this trap of front-running. So SEBI's search operations with respect to alleged front-running is on the back of the share recommendations on various TV channels. But just to put it on board, CNBC-TV18 and the group channels are not among those associated with the SEBI probe. Let's slip into a quick break on that note. On the other side, Amisha Vora, Chairperson and Managing Director at Prabhudas Lilladher, joins in for some stock talk. Also, Kunal Vora, the Head India Equity Research at BNP Paribas, will be with us for an outlook on the inflation picture.
Welcome back. You're tuned into CNBC TV18 on Bazaar Morning Call. Hope you're having a good morning. You've got a few hours of trade before you get off for the weekend. But for the time being, the SGX is suggesting a positive start. 25 points higher is what we're bracing for. Amisha Vora, Chairman and Managing Director at Prabhudas Lilladher, joins us on the show. Hi, Amisha. Good morning. Always good speaking to you. Well, we've got quite a few stocks lined up which will be reacting to news flow. Let's start off with Vedanta. Mr. Anil Agarwal never disappoints. And yet again, he's pulled something out of nowhere. So Vedanta will gain because they'll be getting a lot of money from Hindustan Zinc. What's your view on the stock? You know, yesterday it ended at the high point of the day at around 330 rupees odd. Do you believe risk reward is favorable?
So from Vedanta perspective, definitely this cash is going to come very handy. And this is a large chunk of cash, almost 24,000 crores. I may be not sure, but this Hindustan Zinc is a very majority stake of central government still, almost upwards of 24%. And I think that this needs their blessings still. Because when you give away, this will be almost 24,000 crores of outflow from Hindustan Zinc for the global assets. I'm sure there is, as what I understand, 1,800 crores kind of an EBITDA, but they are all in international assets. To bring it back also is a question mark, and government also is looking at divestment. So one needs to really see that this gets blessings. I'm sure when they announced, they would have done some broad understanding, but one needs to really see that happening. From Vedanta perspective, having said that, this cash will definitely come very useful in overall balance sheet restructuring, which is underway.
Okay. Amisha, good morning and great seeing you on the channel this morning. You know, what stood out for me this earnings season in the mid-cap technology names is that despite all the talk of a slowdown, there have actually been some really good earnings. I mean, we just heard from Coforge raising their guidance. Persistent Systems had a stellar set of numbers. Cyient reported very good earnings as well. It was a strong quarter for them. Is there any of these names where you think perhaps investors can put in money to work for the long term?
So as a house, we are bullish on Persistent. And I can also see as a trend that 2-3 things are very obvious in tech results. One is somewhere or other the turnover, I mean, employee turnover is sobering or settling down. Plus the margins, because of a combination, has a little bit of uptick or stability, except one exception. So those two are very heartening facts. And as what you asked in mid-cap IT, we are bullish on Persistent.
The other big, Amisha, hi, good morning. The other big stock is going to be HUL, right? With this roiling sentiment a little bit. There are two ways to look at it. You can say that they've increased it. Now it's set for the next 5 years, right? I mean, that's the period. So that's good. So it won't go up more. On the other hand, you can say, well, they've done it now at a time when growth, etc., is a little slow. So there may be more hikes coming if growth picks up. So both ways to look at it. But what's your sense? Is it going to hurt too much, or markets will rather focus on earnings and not this issue?
So for FY24, as their part of the hike becomes effective, we estimate that about 0.52 bips it will have impact on the margins. And FY25, as the full impact of this hike in royalty comes, overall it will be 0.72 bips impact on the margins. But as you would have seen in this quarter, and as we believe for next 4 to 5 quarters, the cost to inflation ratio is sobering down, and the commodity pressures are coming down from a peak of 54-55% gross margins. They are still at 49. So the street and we expect that EBITDA margins from here on will increase in 24, and they will be able to absorb this 50 bips hike without much of a worry. So overall, the view still remains that for next year, because of the improvement in cost metrics and the EBITDA margin, levered will still probably report more than 20% kind of a bottom line growth.
Okay, all right. We request you to just stay on for a tad bit, Amisha. We have another guest joining in, so we'll come to you in a bit. Kunal Vora, who's the head India Equity Research at BNP Paribas, joins in now. They've written a report where they retain their cautious view on Indian equities. They say that the lag effect of interest rate hikes should weigh on global growth, even as the worst of the inflation seems behind. And China's reopening and an increase in term deposit rates are likely to impact the flows into Indian equities. Kunal, good morning. That seems to be the narrative playing out, that since China has reopened and perhaps valuations look attractive, a lot of money will move out of India and into China. If that is your base case, what kind of move do you see on the Indian markets through the course of the next year?
Thanks for having me on the show, Sonia. Our view on the market is cautious. Various factors, couple of factors which you already highlighted, that you have had like period of high inflation, and that resulted in like, large rate hikes, and that's likely to slow down the global growth rate. On flows picture, we believe that as China reopens, there will be some reallocations which will happen. Even domestic flows, we have certain concerns. We've had very strong domestic flows over the last couple of years, and that's partially because of very low FD rates and equities offering much better returns compared to bonds. Some of that is changing now. Banks have been raising term deposit rates. There has been a sharp increase, and that will start resulting in some reallocation. Besides that, on earnings as well, we believe that the street is fairly optimistic. If I look at we were looking at about 21 sectors, and across the sectors, the street expectation right now is there will be margin improvement in FY24 and a further margin improvement in FY25. I mean, that looks a little optimistic to us. That results in about 16% earnings kicker. And final point on valuations, again, valuations, couple of metrics. If I look at India compared to its history, historical average is about 16x. We are currently trading at about 19x. If I look at Indian valuation premium compared to Asia ex-Japan peers, that's also at elevated levels. And finally, on bond yield, earning yield gap, that's something which we track very closely. The current gap is about 200 bips. Whenever you had this level of elevated gap between bond yields and earnings yield, bonds become attractive, and typically equities offer a negative returns in the forward 1 year. We've seen that happening in 2010, 2014, 2018. So our view is that while it might not be a year of negative returns, it will be a year of single-digit returns. Our Nifty target is about 19,250.
Okay.
All right. Kunal, let's get to your, I mean, I'm sure you looked at the numbers which are starting to come through. Consumer names, basically. Asian Paints reported, there was a miss. Havells is reported. There's Polycab, which I think was a little better. Lever is reported. What is the sense you're getting about the strength of the consumer? Are they worried? Does this kind of tell you that the slowdown is perhaps getting a little entrenched?
So last year, we were recommending the affluent India theme to the investors. And we were, rural India was slow, and that remained the case throughout the last 1 year. What we are now starting to see is the affluent India basket or the consumer discretionary basket that's starting to show signs of slowdown. You've seen that happening in the paints numbers. You have seen that happening in jewelry, in consumer durables also. The pent-up demand seems to have got played out. Now what we see is incrementally rural India seems to be making a comeback. So far, whatever commentary we've seen from a few companies which have reported, that doesn't really indicate the improvement has already happened. But if I look at the way agro-commodity prices are moving right now, wheat, paddy, milk, all of them are in double digits. The general inflation has moderated. Combination of these factors do make us believe, plus the low base, make us believe that rural India will start making a comeback. Having said that, we still have an underweight on consumer staples as a whole. Our main concern remains valuations. Many of these stocks have seen moderation in their earnings growth over the last decade. Revenue growth is coming below nominal GDP growth rate. Despite that, the valuation multiples have expanded very, very significantly. They are all trading at at least 70-80% premium compared to what they were trading at a decade back. And that's where our concern comes from.
Kunal, it's a very good report, and of course we will talk to you at length about it, but for now we are heading into the pre-opening for the market, so thank you for joining us and giving us a quick take on your report. So that's the word coming in from BNP Paribas. Just to tell you guys, they have an overweight. Their structural growth stories: IT, telecom and financials, and a tactical buy on consumer durables. They're cautious on industrials and the overall consumption space. So that is their basic thesis. Let's slip into a quick break. Let me tell you what's lined up in the next half hour of the show today. On the other side, Anuj will be with us to give us a quick trade setup. Post that, we'll bring you the top stock picks of the day from our technical and F&O experts. After this, Prashant will bring you the Market Laser segment, where we analyze stocks and sectors through a technical lens. And before the market opens in CNBC-TV18 Stock Board, we will highlight the top stocks in the news to focus on for the day.
Okay, welcome back. 10 minutes to go for the pre-open session. Let's bring in Anuj with how he's looking at the trade. It's indicative of a flat start if you go by the SGX Nifty. Anuj, hi, morning.
Morning, Prashant. I think today is a day when you just use the kill feature in your terminal and don't trade at all and do some better things. Maybe watch a series on Netflix or, just go out and enjoy your day, because it's going to be a range-bound day. 17,800 to 18,200 is the range that the Nifty is holding for some time. In fact, I was looking at the chart from 20th December. There's not been a single close above or below this range. The market's been just stuck in this band. Within that, though, the texture of the market clearly has changed. The Nifty IT is closing near highs. The Bank Nifty is closing near lows. And now the divergence, which I've been talking about daily, is 5%. Nifty IT is up 3.5% this month. Nifty Bank is down 1.5%. Just one thing in the global cues, the last hour action of the Nasdaq was a bit disturbing because it slipped from the 50-day exponential moving average, and today it might test the 20-day exponential moving average. I'm saying this because it has bearings for how the Indian IT stocks react. The other thing is the way dollar rupee and dollar index have behaved, and the equities have not really moved in tandem. My sense is the market's preparing for a big post-budget rally, provided there's nothing big negative in the budget, and there's only 6 trading sessions left. Today, as I said, is a no-trade zone. The range is 18,063 to 18,155, which is yesterday's range, yesterday's high and low. And the bigger range is 18,000 to 18,200. So you can smartly play this range if you want to, or you can wait for this range to break and then take a bigger trade. On the Bank Nifty as well, while it's relatively weak, HDFC Bank has sort of got some strength, and that's preventing a bigger decline on the Bank Nifty. But again, 42,600 needs to be crossed for a bigger rally, and for now, I need to play this 42,000 to 42,500 range smartly. Okay, so you said take a break and go watch a Netflix series. Any recommendations? You can watch Khaki, the Bihar chapter. I can tell you it's perhaps the best series made over the last 6 months or so. You'll not regret watching it. Okay, so I have my weekend cut out. Thanks, Anuj, for that. So very range bound. And I guess there's some caution as we head into key earnings as well, right? There's Reliance later in the evening. There's ICICI Bank and Kotak tomorrow. People may not want to take a chance to leave their positions open. So very, very range bound now for the market. Mitesh Thakkar and Kush Bora join in to give us their view. Mitesh, would you concur that there's no real reason for this market to break out of the range either way?
And if yes, what should the strategy be for today?
Good morning. I think in the short term, I would concur with that view. But as Anuj was highlighting, with the impending budget session coming up, I think eventually we'll see some kind of a directional move. But yeah, I think next couple of days still could be more of a situation when the markets are contracting. Having said that, 18,000 and 17,800 are the key areas on the downside. 18,180, 18,250 are the levels on the upside. And while I think in the immediate term, I'm slightly mildly biased on the upside, with a test of 18,250 as a possibility. Only beyond that, I think we'll go aggressively long on the markets. Until then, I think we're trading with smaller positions, tighter stop losses, and more of stock-specific biases. On the Bank Nifty also, 42,000 and 42,700 are the immediate levels to watch out for. Beyond that, some 300-400 point kind of rally can happen in whatever direction the Bank Nifty chooses to break out.
Okay, got that, Mitesh. Kush, what about you? Your call on the Nifty?
See, for 5 weeks on the trot, FII selling figure was going up. Now, if you see, the intensity has reduced and the markets have sort of, shot up already. So for the 12th January expiry week, the selling figure was 10,000 crores. And for the 19th January expiry week, it was just 2,000 crores, right? So if this is any indication of the FII trend, then probably the, the much needed push that the Nifty needs to break out of the 18,300 zone will probably come from, the FII's buying, or maybe the, less selling intensity, that we're seeing. There are very clear indications on the charts as well. 2 points. One, there's a very clear positive RSI divergence on the Nifty, and for 2 days we've closed above the 20-day moving average. So it's passing the litmus test. At least on the short term, 18,300 is where I see Nifty headed. 18,000 would be my stop loss for any long position. And on the Bank Nifty, with the private banks joining the party that the PSU bank started, I think there is more room to the Bank Nifty rally. 42,800 is my immediate target. 42,000 is my stop loss. But positionally, I wouldn't rule out a move to 44,000 levels also in the coming months. So Bank Nifty, I'm slightly more bullish on than Nifty.
Okay, what about trades, Kush?
Sure. Both of them on the buy side. The first one is Max Financial Services. The stock has already seen a stupendous rally, but remember, it's coming from a big slump. There is a lot of room on the upside, but for a more immediate term, 860 is where I would place my target. 830 is where I would place my stop loss. The second pick is from the cash segment. It's Hariom Pipes. The stock was consolidating with a mild positive bias. Yesterday, we saw a breakout. So, this momentum will continue. The stock could very well touch its recent, swing highs, which is at 375. My stop loss here would be 340.
Sorry, which one was that? The second one?
Hariom Pipes.
Hariom Pipes. Okay. Max Financial and Hariom Pipes, two names. And Mitesh, what about you?
Prashant, I have more of buy calls today. Excite is something which appears to be completing a correction and getting into an uptrend. So buy here with the stop below 185. The first target should be around 200. Buy on BEL, Bharat Electronics. Would recommend buying here with a very tight stop at 101.25 and a small target of 107 on the upside. And the third call is Jubilant Foods, which gave some kind of reversals on the half-hourly and the hourly charts. So that's also buy with a tight stop at 505 for a target of 522. And one sell call, Delta Corp, recommending to go short here with the stop at or just above levels of 204 for targets of 190.
All right. Thanks very much, Mitesh and Kush. Appreciate both of you joining us with that perspective and those trades as well. We'll take a very quick break here. We'll come back with a pre-open session. We'll have Shirish Pardeshi of Centrum to discuss the third quarter numbers from the consumer giants, HUL and Asian Paints.